Elizabeth, this panel is all yours. Sale-Leaseback market update. I'll be here if you need me. Just say, hey, Todd, I'm kind of listening in the background, but you won't see me. See you in a bit.
Sounds good. Thanks, Todd. As he said, we are launching into the Sale-Leaseback panel. This is a very interesting time to be discussing this topic, both on the heels of the previous discussion around 1031 disruption possibility. We'll loop some of those items we've already heard about into this one. I'm going to start with introducing or having our panelists introduce themselves. Tim Hall, can we start with you? Just do a quick intro and then we'll go to Mike.
Hi, I'm Tim Hall. I work for Avison Young. I joined the company in August of this year to help lead their corporate finance group. Avison Young, for those who don't know, is a very large commercial real estate firm, 5,000 employees across 120 offices in about 20 countries. So, offer obviously a wide range of commercial real estate services, everything across the capital markets platform, agency, leasing, tenant rep leasing, construction consulting, property management, and then general consulting as well, which is helpful in our corporate finance group. We've got a very strong team, myself and Jonathan Hipp in DC, Jim Hansen in Chicago, and David Krasnoff, who's a debt specialist, is in New York. We've gotten out of the blocks very quickly. We've got about $800 million of deals, single tenant deals in the market right now. So I think we've got a good feel of the transactions and the pulse of what's going on out there. So it's been a good run so far.
Great. Thank you, Tim. Mike?
Thanks. Hi, I'm Mike Fitzgerald here. I'm a Senior Vice President at VEREIT. I've been at the firm for about 12 years. I'm responsible for identifying and executing all the sale-leaseback transactions that our firm does, which typically in any given year could be anywhere from 30 to 50% of what we do at our shop in terms of volume. In terms of volume, VEREIT will do in a given year anywhere, say 500 to over $1 billion in acquisitions. My primary focus has been retail portfolios, which I've been doing over the years. And I also have a secondary focus on industrial, which we do see and identify quite a bit, but we don't execute quite as often because of the market environment. But VEREIT is a publicly traded company. We own about 4,000 properties. We have investments in office, industrial, retail, and restaurants. We also have a couple JV partnerships that allow us to do very low cap rate industrial deals and office deals with our JV partners.
All right, very good. Glen? Glen, I think you may be on mute. We'll skip Glen.
Better?
Okay, there
Apologize.
you go. No problem.
Glen Kunofsky. I am the president and founder of the NNN Pro group of Marcus Millichap. Is where I spend the majority of my time. We're a brokerage group focused on net lease properties. We are very active in the sale-leaseback market. This year we'll complete about $2.5 billion of direct sale-leaseback transactions. For our clients, Marcus Millichap is a publicly traded brokerage company with offices throughout the U.S. I'm also the president of ST&L Advisors, which is an advisory company that helps tenants and sponsors with their real estate, as well as run a pretty decent sized principal investment book in the net lease space.
All right, and Brian?
Brian Shanfeld, Senior Managing Director with JLL, 10 years at the firm. JLL is a global real estate services company. I'm a member of the corporate finance and net lease practice, specialized in advising corporate occupiers, private equity sponsors, net lease investors, and developer clients on monetization strategy and execution for single tenant assets. And that includes sale-leaseback, net lease investments, build-to-suit capital structuring, and lease monetization.
Right, and I'm Elizabeth Randall with the Randall Commercial Group. We specialize in sale-leasebacks and middle market companies. We also do development partnerships and do a big focus on healthcare real estate, of which the majority of that work is through sale-leaseback. So We've got a lot of great questions. We had some good discussion leading into this. So Tim, let me start with this question. It's really a timing question. I know you've done several sale-leasebacks this year. So a group before COVID and a group here recently in the last few months. Can you walk us through what the pricing differential was pre-COVID and now post-COVID, both from a cap rate standpoint? Also walk us through how the structuring from the lease perspective may be different.
Sure. It was really 3 transactions that have, closed during those time periods that you mentioned. The first was a large sale-leaseback build-to-suit for an RV dealership. And we closed that right at the end of February before, the COVID shutdown occurred. We had a lot of interest in that transaction. We closed it with a commercial bank, and they funded 100% of the construction costs. And that was a very smooth transaction. And so then, 3 weeks later, we had 2 deals that were going to close.
But I'm gonna fuck with Rob a little bit.
I don't know where that noise is coming from. We had 2 deals that were going to close probably within a couple of weeks, and the buyers were public REITs. And then as the COVID shutdown occurred, as we all know, those stocks from those companies declined significantly, and they were not able to move forward with the transactions. On both those deals, we had either kind of 12 to 14 bidders because they were strong companies with strong real estate. On one of them, we decided to move forward with one of the backup bidders. But that was during the teeth of COVID. So what happened was, obviously a pricing adjustment occurred, and that was probably 40 basis points or so. But this was a private equity owned business, and it was levered. And so you can imagine, the leverage ratios got a little out of kilter as they were impacted by the EBITDA from COVID. And there's a lot of uncertainty. So what happened is there were certainly some structuring issues with regard to some security deposits were required to get that deal done. But we plowed forward, got that transaction done, and the company was able to shore up their balance sheet with the proceeds. The last transaction I mentioned was probably what happened to a lot of people on the phone. The deal was 2 weeks from closing. The public company stock got hit. They couldn't move forward. So what happened is everything was just put on hold. And so it was put on hold for several months as we kind of figured out what was going on with COVID, but also wanted to ascertain the impact on the business, and then who was going to come back to market from a buyer perspective. So later in the summer, one of the other investors emerged. We restarted the discussions. We're able to get that transaction moving forward, but there was again a pricing adjustment, probably 30, 40 basis points on that. And there was some structuring issues with regard to a security deposit too, but to a much lesser extent than the previous one. So what we've seen is now we've kind of almost come full circle, because we're seeing a lot of the investors come back. We're feeling better about the businesses and have better visibility on where they're going. And some are faring better than others. So, even though obviously there's huge impact from COVID on all 3 of these, certainly on 2 of these transactions, we're able to get them done with some structural issues, but it was important from both of those companies' perspective that they closed. The third one, they used the proceeds to pay down debt, which was significant. So kind of real world examples of what's transpired over the last several months.
For the other panelists, what are you guys seeing in terms of price differential, 8 months ago versus what you're seeing come out now?
I can answer, or go ahead, Mike.
I was just going to say, I think there was, it was a little bit of a surprise maybe that there was a really short period of time where really nobody was looking at deals, at least us and our largest peers. But when they started looking at deals again, it didn't seem like there was some hint that we were going to try to get a little bit of a post cap rate bump. But pretty quickly, I think we realized that just wasn't going to materialize, because there's just so many entrants in the market and so much money out there, that there was somebody willing to step up and kind of reset right back to where we were on cap rates. At least that's been, in fact, in some cases, even lower on some of these essential type businesses. So it's been maybe the opposite of what you might expect.
I would agree with that. That's kind of what we've been seeing throughout. I mean, our volume, similar to the Great Recession, has been upped, and things that have been businesses that have been established in the sale-leaseback market are trading at cap rates that are at pre-COVID levels. Like certain examples, I mean, we run programs for a lot of the national franchisees and franchisors, anything with a drive-through. We've seen extreme demand from the private market. We've sold over 300 million that was put under contract during COVID and closed during COVID. So Popeyes, Burger King, anything that's been showing good numbers during that time. We did see a break of Mike and his peers for a little bit as the publics in the space saw some fluctuations in their stock price and cost of capital. And it's been an interesting time though, because there's a lot of diversity in capital that's out there in the net lease market. And it just shows sort of related to sale-leasebacks, the public companies and REITs that operate in that space really only make up 10% of the overall sale-leaseback market. And there's a lot of numbers that get thrown around, but the private market absorbs a lot of these properties, even fairly large portfolios. And we're seeing that cap rate compression continue. We've seen wider cap rates on some of the things with lesser credit and a little bit more structuring, but demand is still there. But for industrial and distribution assets, we're seeing things almost 100 basis points lower than they were pre-COVID as well.
Yeah, I would agree that that's sort of a similar situation that we're seeing as well. Even in the middle market, it's a big divergence from a sector standpoint with where the cap rates are moving, really not moving so much as a whole, but bifurcating. Mike, let me ask you this. You see such a huge volume of sale-leasebacks coming from a diverse source. And we know that sale-leasebacks come either from companies trying to expand and using the other sources of capital to do that, or we can see them come from an owner-occupant who is converting an asset to an investor-owned asset. With all the disruption, the cost of materials, difficulty developing, where do you see the real source coming from of sale-leasebacks in the next 12 months?
Speaking of disruption, my lawnmower guys decided right now was the time to start mowing my lawn right outside the door here. So I apologize for any noise. I think from my history, where we've seen sale-leaseback transactions has really been from a handful of things. One is large corporations opportunistically trying to raise capital and trying to fit sale-leaseback capital, which is a permanent financing, into their capital structure. Another is private equity groups that are in the midst of completing an M&A transaction, and along with that comes a chunk of real estate, and they want to monetize that in a way to finance the businesses, which has been probably one of the biggest sources of opportunities for us and other REITs. And then existing corporations that are developing new properties in the retail space. You look at the dollar stores, the car washes, and other services businesses that are growing rapidly. They have found that it's a very efficient way to expand their footprint, to use sale-leaseback capital, self-develop and monetize the properties as they build them. It's a very efficient way to use their capital. And I think that's going to continue to happen. We have seen a blip, in the build-to-suit arena. There's definitely been some disruption there. I can point to one deal for Topgolf. Topgolf has been a user of sale-leaseback capital through development financing. We're doing one on Long Island right now with those guys, and there's been a pretty lengthy disruption, from March until mid-August, where they just were shovels down. And so, we worked with our clients in that way, and I'll give that particular group a lot of credit. They've been really good to work with. But I do think that as we come out of COVID, especially with the vaccine and things like that, that you're going to see a pretty quick resurgence. And with all the capital that's out there, I think it's going to be a pretty good year, all things considered, for next year.
So from the standpoint of material cost and the construction and obviously the supply chain that you mentioned, the shovels down scenario, do you feel like it is going to potentially break geographically where some states are more able to move about and have development? Do you feel like it's going to start moving around from a geographical standpoint? I know we often talk about from a sector standpoint, but how do you think that could potentially go from a state by state case?
That's a good question. I haven't given that a lot of thought. We don't do enough volume on the development side to have that be a metric we really look at. I mean, when we're looking at Long Island, we look at things like union versus non-union labor. We look at weather patterns. We look at those sorts of things. We definitely have states where we prefer to work in, and those that we don't, mostly around taxes. But besides that, it's not an area I could really comment on further than that.
Yeah, and I would say we're primarily working in 10 states in the Southeast, and we've just seen a flood of investors from around the country pooling in this area because development is coming out, deals are coming out, and it's really been interesting to see the velocity pick up and where those dollars are originating from.
I think that's an interesting point as well. I mean, one of the things though you have to think about, which is interesting, most sale-leasebacks and most net lease investors are investing 15 to 50-year capital. Mm-hmm. So like the opportunities that creates, it's great that certain states are open and development is happening faster and cap rates, and then other ones are looking at negatively. That's what creates opportunity in a market like this, where like someone doesn't want to buy either a property type or a sector, like certain things like casual dining and other things, and certain geographic locations are being looked at in the short term as negative. And that's where there's some cap rate expansion to be done. And it's a very interesting thing. If you look at it in the world of like a REIT, this is 20-year capital.
Right. So Brian, let me move to you. With certain industries in a cash flow crisis, and maybe that crisis is going to intensify as we get in the next couple of months, seeing what the COVID numbers are looking like. Do you anticipate more owner occupants converting to become tenants to basically raise money on their existing real estate? I know we talked about that happens often in a lot of the private equity world. Do you anticipate seeing more of that to really fuel the sale-leaseback transaction going forward?
100%. We definitely expect to see more companies in need of liquidity to explore sale-leaseback. It's definitely a pervasive trend in times of economic volatility like this. I guess what I would say though is, asset and credit quality will dictate whether those are able to tap the market. There's often a paradox where those most in need of capital, i.e. distressed credits, may be unable to access traditional sale-leaseback capital unless the intrinsic real estate's exceedingly strong or the deal's being underwritten off of real estate fundamentals versus credit fundamentals, or perhaps there's some sort of additional credit enhancement, LC, prepaid rent and the like. But I definitely think we'll see a continuance of a lot of owner occupiers that are asset rich trying to, explore ways to unlock equity trapped in their real estate. And there's definitely, ample dry powder in the market today for sale-leaseback. I mean, we've been talking about that. Flight to safety is creating supply-demand imbalance that definitely favors those owner occupiers, and it makes sense for them to explore sale-leaseback. But there is a flight to quality right now as well, and that's in some ways shrinking the fairway a bit, with a larger share of market participants, looking for opportunities that check most or not all of the boxes. I think groups are a little bit less willing to get too far out over their skis at this point in the pandemic. So, emphasis on quality credits is really creating competition for best-in-class deals and driving favorable economics for those groups that have solid credit and or good intrinsic real estate.
Yes, that's a really interesting kind of divergence in the sense of the companies that really need to generate cash that would need to turn to the sale-leasebacks are going to really be the ones that are raising the eyebrow from the investor and from the lender in terms of a credit situation. So does it come to a point, this is kind of, could be an open question for the other panelists as well, are we at a point where there's enough risk premium to move the investor into those sectors where, there maybe is an increased volume of sale-leaseback trying to raise money, but there's the concern that, is this credit going to make it? Is this brand going to make it? So
I think
how do you
we've seen some of that. Go ahead, Brian.
What I was going to say is I do think that you reach a point in which it's a binary consideration. I think that the market will seek additional yield premium, but at some point you just look at a credit and it's just a binary consideration as to, you take a view on it that either it's a credit you think that it's going to perform, and you're willing to make a long-term bet on the industry vertical and the credit based on where they're positioned and what their outlook is, or you just don't think it's there. And so it's yield premium to a point. And sorry, Tim, didn't mean to.
No, I agree, because this is really where you sit within your industry and what happened to you specifically during COVID and what kind of projections you can put forth over the next year or 18 months. And if you can tell a decent story, you may have gotten, hurt very badly, but there's some trend moving in the right direction. And you know what? The sector is going to come back. And investors, because there is, such an incredible amount of dollars out there looking for a home, let's say it inches up in 7.5, 8 8.25 cap, there's going to be a level where it will clear if it's a viable company, as Brian mentioned. But I think the fact that there's so much capital looking for a home, people are willing to stretch a little bit further than they thought. For companies that, may take 6 months, a year, 18 months to come back, but you lay on that with some decent real estate. When you've got very spotty credit with iffy real estate, those are going to get passed on.
I think the challenge is when you've seen significant deterioration in the credit and you're not seeing any green shoots yet in the financial performance. And it's a hard environment to rely purely on financial forecasting. I think you need to see some level of positive momentum, or the business kind of coming off of a trough and inflecting, if you will.
I think that's the fun part about this time is like when everything was vanilla, call it pre-COVID for the first few years, like there's not much creativity to the business, Today, we're seeing things all over the place. I mean, there are a lot of different segments of the market and the buyers of net lease and sale-leaseback. So there is opportunistic capital that will chase yield on businesses that don't have great real estate, that don't have great corporate credits, but have a story that they were doing really well pre-COVID. And I think one of the things with what's happened over the last week with the announcement of the vaccine is people are starting to look past what the COVID effect is on these businesses. So if you had a casual dining restaurant that had 3 times unit level rent coverage with a depressed credit, for 10 years coming into COVID, and now the rent looks above market, the credit doesn't look great. Is there a home for that today? Sure there is, it's challenging to finance, but that's the fun thing about looking at different dynamics and finding different homes for these investments.
I agree. And I think, industries like, health clubs or movie theaters may be a little tougher putt, but certainly some restaurants and health clubs, because with the vaccine coming, those sectors are going to bounce back. It's just when.
Right.
And so what kind of risk premium you need to assign to that? For-profit education's another one, like are people going to send their kids to school at some point? Like, it's not a discretionary thing. I mean, I know I have 2 teenagers at home. I want them back in school.
So Glenn, let me ask you this. I mean, capital is so cheap. Why do a sale leaseback? You know, what's driving that when you've got so many sources of available capital, not just the traditional sources. We're seeing lots of mezzanine debt come in, alternative investment vehicles coming out to finance these things, just looking for a yield alternative. So why do a sale leaseback when you can go to the more traditional sources to finance the deal?
I mean, I think that's an interesting question. I mean, it goes back to like, who are the players again executing these trades? Like, if you're a public company with an investment grade rating and a big balance sheet, and you can get corporate debt really cheap, you know, and that's an alternative, that may be the best alternative for you. You know, we're seeing a lot of opportunity, you know, and those companies are issuing that. You see like the Dardens of the world in the middle of this issuing $1 billion of new additional debt for a pretty cheap number. But when you're like a private equity backed company that, you know, weighs their cost of capital and what the leverage profile is, you know, a lot of those companies, depending on how they perceive the multiple of the value of the company, look to sale-leaseback as reliable. And the other thing that we're seeing is opportunistically the sort of middle market credits that don't have great access to other alternatives, but have great businesses. We're seeing stuff in automotive service and even entertainment and other things that are saying like, listen, we can go out and buy a weaker competitor at a multiple that's historically great, use our existing real estate. And this is what we saw in 2008, 9, and 10 is, and I did transactions with Mike at that time where, you know what, a 9% sale leaseback isn't horrible when you're going to buy a business, you know, at 4 turns versus 6 turns. So we did a lot of that stuff then. I see more of it happening now, and companies saying, you know what, we can take this real estate, it's 100% leverage, versus even some traditional lenders on good credit on real estate and non-senior secured will only give you 60, 65%. Sale-leaseback's 100%, and sometimes on better performing real estate, you're talking about 110, 120% of real estate value, unlocking that value to make an acquisition on the other side of the business that pays a much bigger return. That's where I say the people that are doing it the most today.
So Brian, let me kind of take that question and bend it different directions. So I started out asking, you know, why do a sale leaseback based on other potential sources of financing? What do you think happens now when we start looking at really fundamental questions of what kind of real estate are we going to need? How does office shift? How do these different potential historically very firm uses of commercial real estate, how does that shift when companies start thinking about flexibility? Do you think that that goes into the sale-leaseback question, really looking for not just a solution to capital funding, but also the flexibility side of it?
Yeah, I mean, certainly that's one of the reasons why you see companies pursue sale-leaseback is, you know, there's what I would call exit sale-leaseback. So if you're looking for back-end flexibility, it's certainly easier to sell an asset today with the cash flow stream tied to it than it is to you know, wake up one day, decide you don't need an asset anymore, and then you're trying to sell something vacant. There's much more appeal in the prior. So you know, I think that part of the market is definitely a viable strategy for a sale-leaseback. It tends to be a more 3, 5, 7 year type of sale-leasebacks if you're kind of looking for, you know, staged exits. But you do see longer term sale-leasebacks where companies make a fundamental shift towards you know, an asset light model and you know, preferring to lease because it does afford that ability to simply, you know, hand back the keys and walk away 10, 15 years down the line as opposed to trying to sell vacant. It's definitely a material consideration when you look at real estate that's in more tertiary market locations as well, where liquidity for a vacant asset could be pretty constrained or somewhat illiquid.
Yeah, and I think, we work in a lot of more tertiary markets, and not only is the liquidity an issue for the vacancy, we're seeing in some cases 50 to 60% discount from what the asset would be as a sale-leaseback versus what it would be sold vacant. So I think that has to drive some of it as well, just from a risk mitigation down the road standpoint. So Mike, let me kind of direct this to you from the standpoint of you coming from a large REIT. Historically speaking, we know who the major investors have been in sale-leaseback transactions. And we made several references, not just on this panel, but prior, about the dollars, the flood of dollars in this area. Who are some of the new entrants that you're seeing play in the space that maybe were not there, 2-3 years ago?
Was that a question for me?
Yes.
We've seen it. Well, over the past 5 years, we've seen the emergence of a couple of really big competitors, and the emergence of a whole different group of people that we're competing with on a normal basis. One is, you've seen these recently made public companies that are made up of professionals that were at REITs, frankly, in the years past. And so you look at the most recent is probably Fundamental Income, which is some store guys that raised some capital, and I think they've done a really good job of getting their name out there. And in fact, I think that when they went out and raised capital, they found that there was a huge demand for what they were trying to put together. And I was pleased to hear that there's a lot of investors that really want access to this type of capital. We also compete, against the 1031 market. It used to be that if, say, a car wash company wanted to execute a $200 million sale-leaseback, they would go to 6 REITs and they would take the highest bid. Now, I think it's become a little bit more sophisticated, and they'll go out they'll carve off a third of the total portfolio, and they will hold it for 1031 execution over a longer period of time. And by doing so, achieve a much lower overall cap rate. And so, sorry, I was echoing there. Can you hear me now?
Yeah, you're good now.
Okay. Yeah. So I think, we're competing against the 1031 market in some respects. And then, I'd say on the outskirts, an area that I don't fully understand because we don't see these guys at the conferences and I don't get to know them very well, but there's international groups and family offices, and private money that will definitely step into these deals, lots of industrial deals and things like that. And occasionally on the retail portfolio side too. So it's a much bigger market than it was when I started in this set part of the market about 12 years ago. So yeah.
So Glenn, kind of getting on the back end of that question, with all these new entrants, what do you think from a macroeconomic standpoint is possibly driving that? Do you feel like you look out and the fixed income market has really been a mess for over a decade now, and we've got this growing population that really relies on fixed income, and that market, even in the last 12 months, has really been very challenged. Does that fuel these new entrants, or what are you seeing there?
I agree with all that you're saying. I mean, I think my view, I've been in this, for over 20 years, and seeing the industry evolve in sort of net lease real estate and sort of who the holders are of it. I still think, I've heard people speak about this in the past, and it's really hard to get numbers about how much net lease real estate is held by institutions, how much is held by companies. I mean, I still just feel the industry is in its infancy, still comparatively when you look at other established real estate funds. And you look at how people want to expose themselves to real estate, and net lease is the best way, most likely, other than owning shares in a security, the benefits of depreciation, of leverage, of the things that were passed in the CARES Act, like there's some real desire to have real estate as a third asset class. And it's just an easy way for people to get into it in a net lease basis. It's got easy fundamentals, and you know, we've seen all these. It's easy to aggregate a portfolio. It's easy to underwrite. Doesn't require that much management. So you're starting to see more and more big capital. I mean, you know, some of the funds that Mike was talking about. You know, these are other, you know, managers of capital that have access to big fixed income things, and they can pool some of that private capital together. You also see it with syndicators, you know, groups that have had, you know, sort of equity in other types of real estate and these syndicators. So it just runs the gamut. And when you're in a zero yield market like we've been in, like, you know, it's a good way to round out any types of either institutional money or private investors.
I would agree that, because we've been talking to a lot of investors going from the 1031 guy that wants to buy a $2-3 million QSR to groups that are looking to deploy anywhere from $2 to $5 billion. And they've got, you know, significant pockets of international capital, domestic capital, and they've got these warehouse lines that are priced at, you know, 3.5%. So there's just enormous flood of dollars, you know, interested in the space. And as the Fed continues to signal that they're going to keep those rates low for the next several years, I agree with Glenn. It's just going to be a very dynamic, you know, investment, you know, sector that people are going to be continued to attracted to, which will shake a lot of properties loose, either in the sale-leaseback or just investment sales from commercial real estate owners that own single tenant properties. It's just a dynamic space.
I mean, when you look at, you know, bond yields today relative to where you can leverage net lease investments, I mean, there's still significant yield premium to go to net lease. You get all the benefits of a hedge against inflation, and then I think, as Glenn said, you've also got your depreciation tax shield and other tax benefits. You know, 1031 for those that can take advantage of it. So there's just a lot of you know, benefit to investing in, you know, a net lease and asset versus maybe just some sort of a vanilla fixed income investment.
So if we think about, you know, really the consistency of the comments here have been that there is an intense demand, and so much so that we have, like you said, new REITs popping up, syndicates popping up, all these groups creating instruments for access to this asset class, this net lease asset class. From a development standpoint, I think we're seeing a significant reduction, and we really saw that, you know, several years, really pre-COVID. We're just not seeing development at the same levels we were, you know, 10 years prior. So this heightened demand, we have somewhat of a stifled supply, you know, particularly this year. Cap rates have been going down. Does that trend, do we really start seeing the migration of cap rates get closer to the bond yields, or is the risk premium going to keep them higher? Where do you think that leads cap rates next? Glenn, take a stab.
All right. I think, you know, I think Brian mentioned it earlier. I think you have a lot of different buckets of capital, like the flight to quality type stuff is one area of cap rates where it's gotten lower than I can even imagine. Things like, you know, an Amazon distribution center trading to professional owners, you know, in the 3 cap range, you know, 375, 350, you know, to me, that's not a real estate deal. But when you have a capital stack and someone will give you 2.5% money and you can fly out billions of dollars into these things, I don't think it's very creative, but it's a use of money. It's a where to put it out. So I think, like, you know, cap rates on that flight to quality stuff, both, you know, and we're seeing it with a lot of the institutions, like with the public REITs with the lowest cost of capital, want to do the safest deals. And, you know, there's real money going into that stuff. You see private buyers, like I talked about earlier, going into the Chick-fil-A's and the McDonald's and long-term leases in those types of markets at very, very low cap rates that don't feel like real estate deals to me. But there's the benefits we talked about: tax shield, depreciation, real estate exposure. And then you have the other side of the market that I think is widening too. I think for creative groups and private equity backed groups that are willing to take a little bit of risk on traditional sale-leasebacks, you're seeing groups like, that are also more creative too in the space. That I think it's all over the place. I think the interesting thing is, there's different pockets of capital chasing into this, and then there's different types of deals. So I think that's why it'll continue to mature. I don't know how much lower you can go in terms of cap rates on certain assets. But I think there's some wide deals. We're seeing double-digit things with sponsors that are, moving along. So that's
But just getting back to your, specific question on development, I've done 2 build-to-suits deals in the last year or so, and there was lots of capital looking to fund the construction on that. So, and there used to be some kind of premium also between, funding, on a takeout versus upfront. That seems to be compressed a little bit. So I think the competitive nature with all the capital that's been articulated on this panel will continue to exist. And so I think if you've got, reasonable real estate, reasonable business plan, there's going to be, creative transactions, as Glenn mentioned, for all types of single tenant net lease assets that have reasonable term, whether it's 10 years, 15 years, 20 years. And we're also seeing, we're working with a couple of investment grade companies that, typically would have, drawn down on the revolver, but they're doing build to suits or just a straight sale leasebacks because, hey, let's monetize this real estate. We don't need to own this. So it makes sense to do that. Even if you could borrow at 3%, we'll do a sale leaseback at 5.5% and just get it off our balance sheet.
So Tim, let me continue with you for a second and ask you this. With regard to underwriting, what's the most significant challenge in underwriting a new sale-leaseback transaction, given the uncertainty of where we are and really not knowing, where cap rates are going to go? I think the idea that we've floated, can they go much lower? I feel like I've been asking that question for 2.5 years. So what's your take on, the underwriting challenges?
Well, the underwriting challenges, I think, have been, discussed a little bit here. It's really what happened to your company during COVID, what's your plan going forward? What sector are you in, and how do you sit within that sector? And I think as we advise clients, we really want to really dig into, a lot of the specifics about their business, because we need to have answers when we call Mike and say, Mike, here's a deal for you. And he's going to say, well, Tim, here are the 6 things that I need to know. So we're trying to head that off at the pass. So he can, when he goes to his investment committee, he can get comfortable with the fact that this company's going to, yes, they had some near-term struggles, but they've turned the corner, and, this sector is going to rebound. So it's really, obviously grocery and food distribution, those kind of companies are going to do well, but it's the ones that were the building products or some other ones that had a short-term hit. But now we're starting to see some real return, I think are interesting, but others ones are going to lag. They're going to lag, and so will an investor, given the amount of capital that's out there, price this at a, 8.5 cap, and take a little bit more risk because they're not winning the deals that are trading at 7, 7.25, 6 3/4 because there's too much capital, because there's 15 people bidding on those. So it's the whole range. It's really company specific, sector specific, and all of us have strong credit skills that can really help evaluate these specific opportunities.
So
I'll jump in on that if I can too. I just wanted to mention, the things that we see on the buyer side is we're always trying to protect a couple key things. One is as much as possible want to have market rents, which in the context of a lot of these deals, a lot of sellers want to drive up rents to drive proceeds, and that'll work to a certain extent. And the other thing is trying on the retail portfolio side is trying to maintain some type of historically normal type of four-wall coverage, 2 to 3 times typically on a retail portfolio, even 2.5 to 3 is better. So a lot of times, that drives proceeds quite a bit more than cap rate, in fact. And so we've seen sellers in the convenience store space particularly try to get very aggressive on coverage, meaning lowering the coverage and driving up proceeds. And frankly, they've gotten away with it because the buyer market is so broad and wide that there's a lot of buyers out there that will live with that kind of arrangement. But those are key underwriting things that we look at outside of cap rate. And then also, of course, we want to have some type of escalations. Our firm has stayed away entirely from flat leases, so that has taken away an entire segment for us, which is grocery, which has typically been a pretty flat lease structure, except for sale-leaseback deals, which occasionally will have that. So those are some of the underwriting elements that we focus on.
Well, guys, we're about out of time. I'm going to ask you each a one answer question. And that is, what sector, which is one answer, one word, what sector do you feel like is going to have the biggest surge in sale-leaseback transaction activity in 21? So we'll go quickly. Tim?
Food distribution.
Brian?
Industrial.
Mike?
Convenience stores.
Glenn?
All retail.
And for me, I see it being healthcare. So that's it for our panel. Thank you, guys. I enjoyed it.